Good afternoon, everybody, and welcome to our Option Pit Basic Education. Today, we're going to talk about when your call is going to get assigned. So if you're short a call, when is going to get assigned? Remember, go to optionpit.com, subscribe, like the Option Pit channel. I'm Andrew Giovinazzi, Director of Education for optionpit.com. I've been trading options for about 34 years. All right, here we go. So, exercising a call. Look at that high tech. So, remember we have our put call parity formula. Now, when is a call going to be? So, you're short the call. In general, we're not going to do the hard to borrow today. We'll do it another time. We're going to just do a simple exercise for div. So, when is your call going to be assigned? It's generally math. Now, meaning that when a call is assigned to you being short one, the liquidity provider is selling a put synthetically. Now I know that sounds a little bit confusing, but I'll walk through it. So again, we go back to our put call parity calculation here. Our standard put call parity call minus put is equal to the stock minus the strike plus the cost of carry. Now, in the case of an assignment, usually the interest rate cost of carry portion is going to be zero, the rebate, because it's literally like the day of expiration. So there's going to be like zero carry for less than a day. So your cost of carry should be zero, and I'll explain what that looks like in 2 seconds. Now, though, okay, when I resolve for this, like, okay, what's the value of my put? Call minus stock plus strike. Again, that's the synthetic. Check our last video out on that. Plus the dividend. What I'm trying to do here is solve for the divvy, right? So you're only going to want to exercise, right? Think about it. What we're doing as a little thought experiment. If the put is worth zero, you certainly want to exercise a call to collect a dividend. So what I'm doing here is I'm saying the put's worth zero. We feed that in. And now what this says is short call plus stock less the strike is equal to whatever the dividend is. But that just short call plus stock is just a short synthetic put. Remember, we did that last class. Again, check out the video on that. So again, that's a buy right. Essentially, it's just a buy right. So when the put value is equal to zero, this is giving you an idea of what the dividend or the dividend now kind of has to roughly be sort of the put value, right, to exercise something. So when you think of exercising a call, what's the move? I'm long a call to start with, and then it goes away, just like I sold it, right? You had a call, now you don't, okay? Generally, you sold it. So your long call, when something is assigned to you, your short call is going to go away. Your short call will be closed, and it will be replaced by short stock. The liquidity provider in general, or the person that owns the underlying or owns the call, they're going to exercise that long call and convert it to stock to collect the dividend. So what happens is their long call goes away and it is replaced by stock. Now, think about that move. You sold a call and bought stock. So every time a liquidity provider exercises a call for stock to collect the dividend, they are synthetically selling a put to their position. So no liquidity provider worth their salt or with a brain in their head or a computer is going to just exercise calls willy-nilly for no reason because they're selling puts for zero, which is essentially what it is. Because when you exercise, everything goes to parity. So now when you think of it like this, it's very specific when a call is going to be assigned. And generally, again, we're not talking hard to borrow, only stocks that are paying a dividend right now, is they're going to exercise those calls the day before the dividend because, again, they're going to keep that synthetic put benefit as long as they can. They're going to exercise the day before XD. So they have to go short that put for the minimum amount of time. So that's why they're going to exercise on XD. Now I'll give you an example of why this is. So here's a stock I have here, CVS, and the stock goes XD on the 19th, which means if I'm long calls, I have to exercise them on the 18th. So I'm long the stock on the morning of the 19th on the open. You have to have the stock in your account to collect the dividend. All the calls here, you notice there's a bid for the 64 put. Why? Why do I want to buy the 64 put? The reason is there's 70 calls in long open interest. And this call here is if you add 545 to 64, that's 69.45, which is a nickel below the bid. So the liquidity provider is happy to buy that call, exercise it for the 66-cent dividend, okay, and then cover the short put and pay a penny and make 65 cents. They will do that all day long. Notice all the calls are bid parity until we get right around here. Now, all of a sudden, these put values start to climb from 36 to 75 cents. So the 69 call that a liquidity provider owns, that bid is now over the value of the put at 66 cents. So the general rule is any call will be assigned as long as the value of the put that you see is less than the value of the dividend that we expect. So every call from the 68 strike down in CVS, generally they're all going to be exercised unless it's a mistake if the stock is at the current price. Then after, on the day of XD, the stock is down by the 66 cents. The calls and puts are reset based on the fact that the dividend is gone, and then on we go. So if you are short the 68s or any call down here, you're likely going to be assigned on the 18th, and you'll get the notice in the evening on the 18th. And you'll see a ton of open interest or a ton of trade here trying to flesh out to see if they can get away with some of these call assignments. So the general rule is if we go back to our little sheet here. Okay, so, right? So the easy rule is your call is assigned when the value of the div is going to be greater than the put price on the strike you're looking at. Right? So that's the general rule. And it's because the liquidity provider is not just going to exercise a call for no reason because they are synthetically selling puts. Their position changes, the risk profile changes, and they're not going to do that unless it's a mistake. So that's why I say is 99.9% those calls will be assigned in CVS because the dividend is worth more than the puts until you get basically to the money. And then it's kind of a pick 'em if they're going to assign it. Depends where the stock goes between, now and then on Thursday. So that's the general rule. In stocks that pay dividends, I'm not talking about hard to borrow stocks. We'll do that as another class. But in general, like S&P 500 stocks that pay a dividend, that's the rule when you're going to be assigned. And don't forget, SPY, IWM, and the Q pay a dividend every quarter. And XD is generally the day before the quarterly end expiration. So if you're doing butterflies, stuff like that, and you have some short calls, you could also be assigned. So again, that's something that we can cover later. But this is the general rule for when your call will be assigned. And if there's a dividend coming and the call is in the money and the dividend is worth more than the put, 99.9% chance that you will be assigned. All right, I'm Andrew Giovinazzi for OptionPit.com. Director of Education at COO. Thank you for listening. There it is. Bye-bye.